Welcome back to Fast Money. Another record day on Wall Street. The Dow and S&P closing at new highs, while the Nasdaq gained almost 1%. The index is still down 4.5% over the past month, but our next guest says it's safe to start nibbling on some beaten-down tech names. Julian Emanuel is BTIG's chief equity and derivatives strategist. Julian, great to see you. Nibbling on what kind of tech?
Well, so the first thing we have to understand is long-term, we think this value over growth trade is going to continue. So what you have to do is be selective about nibbling on tech. If you go back to September, when a lot of, call it FANG, really started going sideways, to us, what happens, the setup the last several weeks, is yields, which had sort of skyrocketed and really caused the NASDAQ underperformance looking at the last 6 or 7 weeks, started to moderate. Essentially, we've been at 160 on the 10-year for the better part of 3 weeks. So to us, that means the household names, FANG, a large part of that, the names that the public understands and is happy to put away for 5 to 10 years are where we want to be.
Julian, it's Karen. Thanks. Your music to my ears, what you're saying. I'm long Facebook, long Google. Do you think, though, that if we see rates continue to go higher, that that will work against this trade? I know they're cheaper than some super high flyers, but will the multiples come in?
So I think part of the issue of these last number of weeks, Karen, is not so much rates actually going higher, but the speed of that. And from our point of view, you go back a couple Thursdays ago, you had that really poor 7-year bond auction that essentially turned yields. Actually, they went spiked higher, then turned lower. You've been going sideways since then. We're okay with yields going higher. In fact, we think they do over the course of the year, as long as it happens in a gradual pace. And we think, among other things, Chair Powell will try to make sure that the market understands that gradual is better.
Hey, Julian, it's Brian Kelly, BK here. I'm curious about, you mentioned Chair Powell. We have Chair Powell talking on Wednesday. A lot of people have talked about some kind of a yield curve control or capping interest rates if they go too high. How do you think the tech names perform in an environment where interest rates are, let's call them capped or a soft capped or something like that?
Well, we don't think he's going to be too aggressive about that kind of cap, because if you think about it, it is really the one area of fixed income that isn't being incredibly influenced. Obviously, the short end is being kept low for a number of reasons. The corporate bond market has the bid, but longer dated yields are rising as a reflection of the strengthening economy, which psychologically the Fed chair is happy to see. Now, if there were to be some sort of cap, again, which we don't think there will be, that would be net better for big tech. But again, to us, the big picture is the economy is strengthening. These are very secular earnings growers. The speculative public, and we know the speculative public is a large part of why stocks have been going up these last number of months, can get behind these names, and that's where we think things are headed.
How much more appreciation could we see in financials, which is an overweight of yours?
Well, Melissa, the long-term picture for financials is very compelling. If you think about it, you look at the last 3 or 4 months, and financials have clearly outperformed. But when you step back and you think about their weighting in the S&P 500, they're still just coming off the lows that we saw in the financial crisis, and that's less a function of the earnings power of financials and more a function of investors' preferences being for large cap tech for the most part, and growth stocks, which again, we think is going to ebb, but financials in general are going to lead the market higher. There could be 10, 20% upside in financials looking at the next 6 to 12 months.
All right. Julian, good to see you. Thanks. Julian Emanuel of BTIG. In terms of this notion of Brian, I think it was interesting that you mentioned, BK, that is, this notion of soft cap or capping or whatever. And Julian had said something to the effect of, if Jerome Powell can convey to the markets that a slower ascent of yields is better, he can't really do anything. I mean, if he's not going to soft cap in any way, all that's just talk. I mean, look what the markets have done. I don't know if this ascent was slow or fast. Felt kind of fast to me as a layperson in this.
Yeah, listen, and it was fast in the market's eyes, too, because we had this sell-off. But what's interesting is it was about 2 weeks ago with the jobs number. All of a sudden, the equity market on that jobs number stopped caring about interest rates. So for now, I think we're okay. Jerome Powell does not have a great track record of calming the market down on his first try. It usually takes 2 or 3. So there's always a risk on Wednesday that he says something that riles the market. But I think, if you have stabilized interest rates somewhere around this level, then that is pretty good for equities, barring some kind of major inflation event. But that's not what investors are worried about today.
Tim, you think Jerome Powell threads the needle?
Threading the needle is so hard to do. Brian brings up a great point looking at his past track record on the first kind of pass, not so good. But I think it's really just about managing expectations, of which slowly this is where we now are, and also an understanding that the Fed not only is probably impotent to do a whole lot outside of Operation Twist and whatnot to the long end, but that they're probably going to sit very, very tight, and that good news is good news in terms of the economy, but that, ultimately get back to the parts of the market that are really working. Remember, it's absolutely transports, it's absolutely industrials and banks, and I think you're feeding into that story here. So as much as I actually don't think mega cap tech is dead, and an 8-month consolidation in Amazon's share price and in Microsoft's share prices are things that I think you want to buy, I think the strength that we've seen in the markets is not something I would fade.
All right.
Shepard Smith here. Thanks for watching CNBC on YouTube.